Global PMI surveys overnight suggest the US economy is rollicking along in a way that might force the Fed to keep rates high for even longer. New Zealand retail sales bounce, and there's hope tax cuts in next week's budget might give them more of a boost. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ahead of Japan's inflation data later today, ANZ senior international economist Tom Kenny explains why he thinks the Bank of Japan will hike rates again in June and October.
They gave the impression that they had very little tolerance for upside surprises on inflation, given that inflation is running above 2% at the moment, and they're getting greater confidence on that being sustained.
But first, in 5 and 5 with ANZ, US bond yields rose 4 to 5 basis points, and US stocks fell about 0.5% overnight after global surveys of businesses, the PMIs, were stronger than expected in the United States. That's forced investors to revisit their assumptions about whether the Fed can cut interest rates this year, which in turn pushes up bond yields and makes dividends from stocks relatively less attractive. The US dollar firmed with those high yields, rising about 0.2% in its main index form. That drove the Aussie and Kiwi dollars lower by 5 a.m. Sydney-Melbourne time. The Aussie was down 0.25% at 66.01 US cents, and the Kiwi was at 60.97 US cents. That's off its overnight highs of 61.34 US cents. ANZ's head of G3 Economics, Brian Martin, explains why the global PMIs were so important.
We like that economic activity is very resilient despite the fact that monetary policy has been tightened dramatically. Having slowed in the early months of this year, the US composite PMI bounced back in May to its highest level in 12 months, and the services index was actually at its highest level in over 2 years. So that does suggest that economies are holding up despite monetary policy tightening, and that the no-landing environment, certainly as far as 2024 is concerned, is increasingly the most likely outcome.
Number 2, Japan's nationwide CPI for April is due later today. ANZ senior international economist Tom Kenny says the market is expecting the annual rate to ease from 2.7% to 2.4%. Listen out for more on Japan's interest rate and inflation outlook in our deep dive later on.
The Tokyo CPI surprised a little bit to the downside, and that's usually a good indicator for the national CPI. Some education subsidies distorted that reading, so in a sense that's the kind of a one-off factor driving inflation there.
Number 3, the Bank of Korea held its policy rate at 3.5% yesterday. ANZ economist Crystal Tan says the Bank of Korea reiterated it wanted to maintain restrictive policy, but has left the door open to rate cuts in the second half of the year. Attention in the Asia-Pacific region now turns to Malaysia's CPI out today. Here's Crystal.
In Malaysia, we expect month-on-month inflation to have edged up, led by a modest pickup in food prices. However, base effects mean the headline year-on-year print likely held steady at a benign 1.8%. Now, there may be some upward pressure on inflation going forward, given the government's plans to remove blanket fuel subsidies. But on balance, we think price pressures will be manageable and not trigger any monetary policy action.
Number 4, Singapore's final Q1 GDP was unchanged at 2.7% annualised growth, with downward revisions to manufacturing offset by a stronger services sector. Meanwhile, core CPI in Singapore was also steady at 3.1%. Here's ANZ's head of Asia Research, Koon Goh.
All the data was in line with expectations, but core inflation is still elevated at above 3%. We expect core inflation to moderate towards the end of this year, but given the growth and inflation outlook at present, the MAS is expected to remain on hold, and prospects for monetary easing is likely to be a 2025 story.
Number 5, New Zealand's retail sales rose 0.5% in the first quarter. That's after 8 quarterly falls in a row. ANZ senior economist Miles Workman says while the bounce represents some upside risk to the Reserve Bank of New Zealand's first quarter GDP forecast, the picture is still of a soft economy.
We don't expect to see a very strong upwards momentum from here, just given the ongoing persistent headwinds facing the industry, such as still restrictive interest rates, loosening labour market, falling migration, and just that general pessimism across consumers. The one small bright light at the end of the tunnel perhaps is the government's proposed tax cuts. However, these are expected to be relatively small in the scheme of things.
Miles Workman there. Now, on our bonus deep dive interview, ANZ senior international economist Tom Kenny reviews how the commentary from the Bank of Japan, the BOJ, has shifted in recent months and why that points to more rate hikes.
Firstly, post the April BOJ policy meeting there, Governor Ueda came out and he was a little bit, I would have said, dovish. So I was quite surprised post the meeting to look into the details of the summary of opinions. In that, the members there came across as being reasonably hawkish. Firstly, they thought that the economy was on a good track and was potentially going to be growing above potential. And when they considered the fact that they looked at a few capacity measures in the economy, notably for production and employment, and that these were tight, they were suggesting that there's potential for inflationary pressures to grow there. So they gave the impression that they had very little tolerance for upside surprises on inflation, given that inflation is running above 2% at the moment, and they're getting greater confidence on that being sustained. And in terms of potential risks for upward risk for inflation, the currency comes front of mind. The yen has been depreciating against the US dollar for a little while now, and it is flowing through into higher import prices. Now, the second factor that led me to change my view was the fact that Governor Ueda, who, as I mentioned before, came across as being very dovish post the meeting, a couple of weeks later, after having a meeting with the Prime Minister Kishida there, came out afterwards saying that he was quite concerned about the level of the currency, and that he outlined two potential scenarios in which the BOJ might adjust policy sooner. And thirdly, we saw just last week the Bank of Japan surprised the bond market there by reducing the size of its outright JG purchases in the 5 to 10 year range. So this saw JGB yields rise, and this was the first reduction we've seen in this scheduled purchasing since late last year. In part, I think purchasing less reflects a couple of things. One is that it helps with the yen in terms of the higher yield and a yield differential working in their favour. And secondly, the Bank of Japan is, I think, having issues with its size of its purchases in the JGB market. It is distorting the JGB market there because of the large purchases that it makes. And potentially we have a feeling that at the next potential meeting that they could start about quantitative tightening. That is easing back on the buying of JGBs because they are causing significant dislocation in the JGB market there.
So what are you expecting the BOJ to do over the next year?
Well, my expectation is that they will act on this weakness in the yen in the sense that this is presenting an upside risk to their inflation outlook at a time when we've got sort of services inflation running at 2% and likely to stay at that level. So there's little tolerance for goods prices to go up there. So I think that they will take the cash rate up by 15 basis points at the June meeting to 25 basis points. And beyond that, I think that we are seeing some evidence that there's solid signs that we're getting greater traction between wages and inflation. And wages have been running at their fastest pace for some decades now, and that this is going to be a consistent sort of virtuous cycle between wages and inflation. And we believe that by October that the Bank of Japan will be revisiting its inflation outlook and potentially revising that higher, and that would be a trigger for another rate hike from the Bank of Japan.
Tom Kenny there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 24th. Catch you next week with details from Japan's CPI today and a look ahead to Australian inflation data due next Wednesday and New Zealand's budget on Thursday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.